Shantanu Sengupta of Goldman Sachs is ready. Let's connect with him, India Economist with Goldman Sachs. Shantanu, it's a touch wood, but it's just one of the phases of the economy where the economy is firing full cylinders. Monsoons are good, forex reserves are strong, current deficit is coming under control, tax and GDP ratios are looking decent. So whichever line item I look at it, all line items are indicating that we are in a good shape.
Indeed, I would agree that macro stability has been the hallmark of India over the last 10 years or so. So if you compare it to taper tantrum versus now, all the indicators that you pointed out, current account deficit, lower inflation under control, the fiscal, I would say, which expanded during the pandemic, but frankly, India wasn't an exception because all other countries also expanded their fiscal during the pandemic, is on a path of consolidation now, and we expect that to continue. Because if you look at overall, stability dynamics, the only place where India is an outlier is the debt to GDP in terms of public debt. It's at 80% plus. It's one of the highest amongst EMs. Agreed that we have high growth, but over a period of time, that debt to GDP number needs to consolidate to below 80% and probably get close to 75. Which is why we think that the government is very likely to stick to the fiscal consolidation path and target 5.1% of GDP in fiscal 25. But the more important thing is that going forward, also we expect that consolidation to continue towards 4.5 or lower fiscal deficit for the central government.
Areas of the government has been that they've been spending on capital expenditure. The number as percentage of GDP is north of 3 to 3.5%. Do you see that will continue, or that number could get compromised given that rural economy and the semi-urban economy is under stress?
No, we don't see a pivot in terms of the government's expenditure priorities. See, one thing we have to understand is that at the end of the day, your fiscal is consolidating from 5.6% of GDP fiscal deficit to 5.1. So whichever way you cut it, fiscal policy is going to have a negative impulse on growth. It cannot be positive. Within that, if you break down welfare spending, subsidies, capex, etc., you're absolutely right. When you raised your capex from 1.5% of GDP to north of 3% of GDP, that provided a positive impulse to growth. It can't continue with that kind of growth rates anymore. So we think it will flatten out more in terms of percentage of GDP. So you're more likely to be in the region of 15% or thereabouts for capex growth. Budgeted number was 17% year over year after a cut in the previous year's numbers. So you're likely to see that kind of a number for the semi-urban, rural, which is more of welfare and subsidies. There could be a little bit of a tilt. We are seeing some reallocation of spending from elsewhere. Maybe the RBI extra dividend partly gets spent there. But it's difficult to imagine that number can give a serious fillip to that part of the economy. Again, the important thing is you're moving from 5.6 fiscal deficit to 5.1. So it's very difficult for fiscal policy to have a positive impulse.
I'd like to draw your attention to what in a sense is the biggest talking point, which is that what are the new so-called schemes, initiatives or waivers we could see, given that there is expected to be renewed focus on the compulsions of the economy, which is the slowdown in the rural economy, taking care of the social needs, so to speak. Do you expect anything incremental, anything very large to be coming out from this year's budget, at least on that front, which in a sense has been ignored in the last couple of years?
So in terms of social security net, I think that has been in the works for the last many years. Even pre-pandemic, building a social security net in the form of more insurance or small amount of fiscal transfers, that has been in the works, and that probably continues. So could you see a higher allocation to a scheme like PM Kisan? Maybe, yes. But it's remained constant in terms of INR nominal terms over the last 5 years. So even if you're increasing, you're basically catching up with inflation. Again, the important thing is that when you have 3.5% of your fiscal deficit being spent on interest expense only, there's only so much space that the government has in terms of focus of the government is going to be on the rural economy, but a thrust on the food supply chain and inventory management to control price volatility. So if you think about the rural economy and if you think that inflation has eroded real incomes, then the inflation volatility or the price volatility of food especially is something that the government would be keen on containing. And that would mean better rural infrastructure for connectivity, cold storage, chains or facilities, improvement in the irrigation network, grading, sorting, food processing, all of that will probably come under focus. You're going to see, probably commentary or incentives on that, enabling domestic production of a lot of food. Edible oils, we are a large importer, so incentives for producing edible oil, pulses, vegetables, all of that which contributes to the volatility is somewhere where we are seeing the focus, and overall reduction in input cost of machinery. On the housing front, we've already seen the numbers in terms of the Pradhan Mantri Awas Yojana coming through. We see that continuing, more of slum redevelopment possibly in the urban areas. Those are the kind of policy push that we are going to see rather than direct transfer to the households or higher amount of subsidies, because the space in terms of the fiscal account is very limited, as I pointed out.
Yeah. Shantanu, thanks very much for joining us on the show.
If you like this video, then like, share and subscribe to ET Now.